Good morning, traders. Welcome to the Flow Show, Friday, the 12th of September. Not unlucky, Friday the 13th, fortunately. Friday the 12th. And we're over the big data hump in the US. Eyes now turning to the Fed next week and what everything we've just had over the last couple of weeks means for that decision. And we'll get into all that in a bit. Morning, Kay. Another week under the bridge, nearly.
Morning, Ryan. Morning, everybody. Yes, indeed, mate. We've made it to another Friday. Actually, a bit scary because it's already we're already mid September. Yeah. Well, what shall we say? The big expectations got only partially met, perhaps.
Yeah.
What moves are concerned, anyway.
Yeah, we're halfway there. This the data is one piece of the puzzle. What the clowns at the Fed do with it is the second part of the puzzle, and
Yeah.
we won't know that till next week. Anyway, let's get into the headlines. Everything else that's been going on around the world. Over in Japan, we've had sort of confirmation that Koizumi intends to run for LDP leader, according to Senkai. We've also had a poll out from Kyoto saying that Takeichi leads the race at 28% from Koizumi at 22.5. The other known confirmed runner, Hayashi, he's coming in at 11.4%. So pretty much as expected in terms of that. As I reminded people before, Takeichi won the first round last time against Ishiba and Koizumi, and then lost in the final round to Ishiba. So taking an early lead there anyway. Kate is, apart from any left field surprises, we should probably think that she's going to be the one, no?
Let's say the two runners are probably already known in Takahashi and Koizumi. You never know because as you said, the prior leader election, she was also front running, and then Ishiba got the support of quite a few of the others, and never rule it out. Never rule it out in Japan. It would be a historical moment, right? Because it
Yeah.
would be a woman becoming prime minister. In the facts, electing her, as we've already been saying, it's Abe version 2. And that is what the market is currently already trading and foreseeing, because we see those yen pairs are just remaining bid, right? Yeah, I mean, if it's Takahashi, let's say the good thing for us traders, Takahashi will be a bit clearer than maybe the rest. I mean, we have those two extremes. Takahashi one side, Motegi on the other side, and all the others in between. Koizumi is perhaps seen as a negotiator, so trying to get everybody on the same line, but which also means that in any case, LDP can't decide on anything on their own. So, because we were trying to find out what his fiscal policies are, but I don't think he's going to be. He may be not as soft as Takahashi, but I wouldn't qualify him as a hardliner either. His
Yeah.
father was one after all either. So, yeah.
Could his age be a swinger in this? Because always appointing old people into the
Yeah.
role.
Mm,
Yes, obviously Takaichi would be a landmark being female.
yeah.
But could they take a different path and look to put someone in younger? Add a bit of
Yeah.
dynamism to
This
the
question.
affair.
Yeah. This question up to 4 or 5 years ago would have been a no-brainer. Koizumi would have got it because that is how Japan chooses its leaders. I'm not saying that they are completely against women ruling the thing, but look at how difficult it has been to get women on boards in Japanese companies, etc. They're still very
Yeah,
much the Japanese ink, and Japanese political world is still very much ruled by men, right?
Yeah.
The question today could be different, and also because she will have the backing of Abe side, right? Abe is still seen as somebody who has done actually a lot of good to Japan, right? And
Yeah.
so this time could be different indeed. I will say that somewhere it would be logic that she gets it.
Yeah. 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 The cultural thing is something that's definitely going to come into it.
Yeah.
I should think as well. But, yeah, we shall see. Anyway, um, I did put this down, but I've just seen that it's the ex-currency diplomat talking, so not really much worth raising his comments. But he said the BOJ must take into consideration concerns that the weak yen could accelerate inflation and that interest rates are too low, contributing to yen weakness. But as I say, I've just seen that was the ex-diplomat. So no need to worry about that. Riksbank Steden with some interesting comments saying that banks need to prepare to manage more of their liquidity in the overnight market. Says that if banks are to conserve central bank reserves and not demand more than they need, the interest rate cannot be too favourable when banks place reserves with the central bank overnight. Now, this isn't something we can jump on trading straight away. But it is potentially another bank move into maybe some sort of tiered rates. Just to give you a very quick overview of things, if banks have spare cash, they park it at the central bank where they earn money. Some banks can park excessive cash for an extended period as well. Governments, banks would like that money to go to work rather than sitting earning money off the state. Hence why we've had tiering situations by the likes of the SMB. So, Kay, is it something we need to keep an eye on? Could they be going down that road? And, that would have some potential FX implications down the line.
Mm, uh, yeah, it's a possibility. Riksbank is free to do what they want. They probably have been looking at what SNB is doing as well. Yeah, would it be a slightly negative Swedish krona? Because if they put less favorable conditions in place, that means that the banks with their excess liquidity are going to get less money and perhaps are going to look elsewhere, maybe. Bit of outflows of Swedish krona.
Yeah, yeah, it's possible. That's probably the way to look at it. But yeah, it's just, as I say, this is early idle thoughts at the moment. So no one's going to jump into trading that right now, but one to keep an eye on over the months ahead, at least. Right, over to the good old UK, where we're going absolute gangbusters here in the economy with massive 0.0 growth for July. No growth in July whatsoever, down from the 0.4% seen in June. Now, within that, we know that the retailer has been pretty strong through the summer. That's indicated as part of the index of services, which was up 0.4%. So, by the looks of things, everyone was on the beach spending. No one was at work, hence why we got zero GDP. And if it wasn't for that spending, we probably would have seen even worse GDP. I think Mr. Brown was counting the third decimal places that would have taken it lower still. Industrial production, not looking overly great as well, but that can be a bit of a swinger. The 3-month rolling GDP number, you can take that as a sort of rolling quarterly number, coming down to 0.2% as expected, down from 0.3 prior. So July is the first month of Q3. So this rolling number will give more of an impression of how the quarter's playing out. But nothing of note in those numbers to get anyone excited going forward. And we'll wait to see what happens in the autumn and into the winter. We do have some final CPI numbers out of Europe. No real changes there in Germany nor in France. Everything ticking along there. France still the weak link in terms of inflation being well below target, or the ECB's target. Anyway, Spanish inflation, that was up. Bitcoin CPI up to 2.4 as expected. Headline CPI unchanged 2.7. The Eurozone measure also unchanged 2.7. Running fairly hot in Spain. As you see, the different Spain's got a far better economy going than France at the moment. And that's why you tend to see better inflation numbers in stronger economies than in weak ones. So that's a bit of a lesson there. Who are we going on to next? So we're going to go back to the UK. There's been a Bank of England Ipsos inflation poll, which has seen 12-month inflation rising to 3.6 from 3.2. Again, not something the Bank of England will like to see. And yesterday, well, I was talking all about that Mandelson crap going on. He finally got the old heave-ho by Starmer, but Starmer's in hot water now with his own MPs, with, according to FT, some doubting his leadership. So that political rumblings are going to continue on and on. The interns at the French Stats Office must have been high on tyre fumes, burning tyre fumes from the strike going into work yesterday, because by the time they got to the desk, they thought that GDP will be expanding in 2025 up to 0.8% from 0.6%. They reckon it's going to grow 0.3% in Q3 and 0.2% in Q4. Both prime numbers were 0.2%. It's been a while since anyone over there has raised growth forecasts, but it's not much of a forecast since we're in the last quarter of the year anyway. So if they can't get it right 3 months before the year end, they've got no hope. Right, back to the good old ECB, and a pretty dull affair as expected. They held rates as expected. We had a little bit of shenanigans with the headline writing over all that. Bloomberg reporting that the ECB saw core inflation as more important than headline inflation, though that appeared nowhere in any of the ECB publications. So I'm still at a loss as to what games Bloomberg were playing there. But if that had been confirmed, it would have been a quite significant line, because this is a game the ECB has played before, when they move focus from one inflation measure to the other just to justify their means and ways and what they're doing about it. But that doesn't look like it happened anyway. Growth and inflation forecasts were largely unchanged. 2025 inflation went up a pip to 2.1. 2026 went up a pip to 1.7. 2027 went down a pip to 1.9. Core was all pretty much unchanged, 2025, 2026, and down a pip 2027. Growth was all unchanged except for 2025, which has gone up to 1.2 from 0.9. So really nothing in all that. Lagarde, I don't know. I had to look for the headlines of what she said, because I had none of it yesterday while she was waffling on. I was too busy wondering whether that brooch of hers was going to shoot laser beams at all the press pods at some point. Anyway, she said the risks to economic growth are more balanced. The outlook for inflation is more uncertain than usual. Stronger euro could bring inflation down more than expected. Says the disinflation process is over, and that a minimum deviation from target will not necessarily justify a rate movement. She also had a dig at the US and maybe the UK, saying the integrity of the data the ECB uses is very high. The staff projections said no real changes. They took out the alternative scenarios. They had a mild and severe alternative scenario in their last projections, which was covering all the trade and tariff stuff. That's all out. The overall theme is that the risks from trade and all that sort of stuff, that uncertainty, is far less now. The ECB are in a good place. Inflation's in a good place, rates in a good place, and now they basically hoping that they can keep everything there in that place. Obviously, you've got the sources out after that. The first lot of sources said that the debate on an ECB rate cut is not over. but October is seen as too soon to have that next debate, and the next real discussion will more likely be in December. Sources after that said that the ECB are inclined to keep rates unchanged, barring an economic shock. We have money markets pricing a 50% chance of a 25 basis point cut by June in 2026. That was down from 60% before the ECB, and it's down to 40% today. JP Morgan expect the ECB, though, to cut in December versus their prior forecast of October. Kay, pretty much as expected from the ECB. A lot of the market now thinking that they're done and dusted for quite some time. Do you agree?
You spent a long time, Ryan, going over all the stuff could have been done, and she could have been done as well in 7 words. The ECB in this case. That's exactly what happened. That's what we expected. That's what happened. Yeah, minor revisions to projections. If nothing spectacular happens, I think they could be on hold for the rest of the year. Yeah, December is still a debate, and we know that one side and the other side of the ECB governing council spectrum, you will have the Germans, a couple of others, really thinking that they could actually even hike after a while, but the rest is probably going to keep them neutral. Yeah, we got what we expected. An hour to say that this is the dullest ECB meeting that we had for a very long time. Yeah, pick your side. We can already look forward to the Fed meeting. But we have to still acknowledge that inflationary pressures, they are kind of anchored, right, around that 2% right now, which is well below the US, which is also their rates are well below the US. So what it means for the euro, she was, let's call it, tilted more to the end dovish side than she could have been, right? Like keeping a lot of potential open to go further down the road. She was really saying like, nah, this is where we go. She also even said that the disinflationary period was over, even during her press conference. So that was a bit leaning towards the hawkish side. But against that, and we've been talking about that as well. If you look just between ECB and the Fed, there's 2% difference in interest rates. There's still a difference in growth. There's a difference in inflation. That's what we got as well as a reaction in the market. We went up to 117.5 again, and now we are back somewhere floating in the middle of that range, and that gives you an idea of where the market's heads are at as well. Undecided to what to do with this.
Yeah, from a trading standpoint, I'm absolutely overjoyed that they're now all claiming victory laps and that they're in a place they want to be, and they're going to be there for a while, because I've been saying it since late 2024. They are going to be taking rates lower than they expect or want, and I can still see that happening. Purely, as Kay has mentioned, the difference between Europe's economy and the US economy, it really is chalk and cheese, and unless all this defence spending and whatnot boosts the economy, I don't see any reason why we're going to see a meaningful pickup. Yeah, we can gyrate around plus 0 point this and minus 0 point that, as it has been, but we've already seen France doing the likes, firms cutting costs and cutting prices to try and encourage business. So I don't think any which way the ECB is out the woods on rate cuts yet. The perfect storm for me, because I'm long euro sterling, would be Reeves and co to fuck things up into the end of the year, get a nice rally in euro sterling over the next few months, and then when I think the ECB is going to get crunched, start piling into shorts. But that might be a trade that takes 6, 8, a year to play out, but I think it's going to be something that's going to happen still.
Unless,
Yeah, go on, mate.
unless in the meantime Germany wakes up. Huh? We are still waiting for those big investments to start rolling in. Defense spending, investments. There's like, what is it, 600 to 800 billion in total euros or so. Slated to be invested in defense plus all those companies. Unless they wake up, I mean, that could be the savior of Europe. Is not Europe, but the euro, because Germany is still the biggest country out there. That could be it. And then let's also not forget, I mean, increasing spending, what are the companies going to do? Lower the rates, lower their prices? I don't think so. If the Germans come in with their big boots and they want to buy everything that's around, I think that's actually going to push inflation a bit higher. And in that case, they can keep it for longer and the euro can do better, which is going to be great for the euro sterling, because well, I'm a tad long as well, not overly long, but yeah. So if Germany saves Europe, then the euro could go higher. But the longer that takes, the more it's going to remain in the mud. Because, as you say, France, I can't see France stand up. Really, I can't.
Yeah, no, exactly. And that's the other thing with when you get big infrastructure spending and the likes, you can get a short-term boost in GDP and stuff, but this stuff will be over 5-10 years, and you can't trade that now. And I'm always skeptical of infrastructure spending because it goes over that long period. So you're not going to suddenly see 3% growth forever. It'll be a short-term shot in the arm, if anything. And considering it's all going to be in defence, well, what do you do once you've restocked all your arms and bombs and whatever? That's it. You're done. So yeah, I'm not expecting miracles for all this spending that they're going to be doing. But anyway, that's for the months ahead. As usual, floodgates are open now. The shackles are off. All the ECB bods are all come screaming out, finding the nearest microphone. As of now, we've had 9, unless any have popped up since I've started the show. ECB's Patsilidis, one of the hawks, turning up, potentially saying the next move in rates could be up. He's not the only one saying that today. But he says there's no need for imminent action barring any shocks. Vilroy says several of us underlined downside inflation risks at the meeting. Another rate cut is possible in coming meetings, saying that upward risks to inflation are lower than downward risks to inflation. Says the ECB must and can tackle its budget problems. Yeah, I'll be on the other side of that as well. ECB's Kestrel Kazakh says there cannot be a predetermined path for the ECB. We are in a good place on inflation. Says the December meeting is rich and projections will show if there's a deviation from the 2% target and how persistent and large it may be. He's also citing the exchange rate as a key risk alongside Chinese trade flows. Something that the guard did say is that they are expecting inflation to maybe move away from the target early in Q1 or in Q1. So they are expecting some deviation there. ECB's Muller says rates are in the right place right now. ECB's Escriva says we've reached our inflation target. GDP growth is slow and competitiveness is a problem. ECB's Simkus says inflation risks are significantly high. ECB's Ren, no room for complacency, will stay vigilant. We must be mindful of downside risks to inflation stemming from cheaper energy and a stronger euro. Another comment on the euro. Nagel, steady hand policy is appropriate. That inflation remains slower than target should not be underestimated. ECB's Kocha, new guy, says ECB didn't discuss a next rate move. Also said rates could go in either direction next. So that's all the wafflers thus far. Right, going back to yesterday's stuff out the US and the big data. Firstly, we had a little blip in jobless claims, a jump to 263, one of the highest we've seen for quite some time. Market got a little bit panicked over that, but that's likely due to the holiday that we got last week. The Labour Day holiday might have skewed that number. Continued claims stayed, well, actually went down, unchanged, but they went down versus expectations, staying at 1.939 million. So nothing in those numbers. And then we got the CPI data, which pretty much came in as expected. Core CPI 3.1% as expected, unchanged over last month. Headline CPI went up to the 2.9 that was expected. The monthly numbers positive as well. The super core, everyone likes the super core. That was pretty much unchanged year on year. But we did see a drop in the wage numbers. They came in a bit softer. Real earnings there, as you can see, down 0.1%. The year-on-year numbers, though, came in much lower than they were previously as well. So a bit of wage easing going over there in the States, something to keep an eye on as well. Rates pricing after all that data shows market looking at 4 straight quarter point cuts between now and through to January. 3 cuts have been fully priced by the end of the year. A Reuters poll showed that the Fed will cut rates by 25 pips next week, according to 105 of 107 economists. That was up from 67 of 110 in last month's poll. They also say that the Fed will cut by 50 basis points this year. So say 64 out of 107. 40 say that they will cut by 75 pips for the rest of the year. So there's some disagreement over whether they get 2 or 3 cuts. Kate, I want to ask you about the reaction, because we saw 2 negative data points, the jobs division and PPI, which you thought you'd get dollar selling, and we had a blip lower and then dollar rallied, and then we've had data where you think the dollar would be bought and it got sold. What's going on?
And look where we are.
I'm going to put my feet up while you answer that one.
And look where we are. I mean, that's the thing. We had, you could argue that jobs number, but I mean, CPI didn't give us anything, did it? Or everything as expected. And the question remains. It actually remains. I do agree that the risk for them to cut more than twice before the end of the year is higher, and I've always been actually on that side of the trade of late. I think the risk for them to cut more is higher, because it's not going to need too much of a weakening of growth or worsening of the job market to take them over the edge. And they will do everything they can to keep the growth in the job market going. And as they all said, I mean, inflation has taken a bit of a backstep. And let's not forget that we have had now more and more dissenters to the dovish side as well of late. So there is a bit of a case to make there, but it is not what the data really told us yesterday, right? I mean, the data just, I mean, they came out relatively as expected. We didn't see a big drop in inflation. We didn't see a rise in inflation. And then we had but we had a bit of a slowdown in wages. You could argue that, but where I was expecting the longer term players to really come in the market and say that, okay, now we know we are over this hump. We had everything. We had the Jackson Hole, we had the jobs report, we had the revisions. Now we have the CPI. Now we can start to trade and take it. Actually, take the dollar somewhere lower on based on the balance. It did not really materialize, and yes, the dollar is trading lower versus most, barring sterling and euro, let's say. But it's not your gangbusters move or say like, let's get rid of the dollar because this thing is going to collapse, right? So we may even have to wait until FOMC to really know where they are all at, and especially where Powell's head is at, you know.
Yeah, absolutely. And as I've been saying the last couple of weeks, we know where the market's at. The market's at between 2 and 3 cuts the rest of this year. So that takes them down to the midpoint 3.62 in rates. We know the market is thinking next year 3% is a landing zone. So the Fed were expecting 2 cuts this year. Has that changed? The Fed were expecting a rate of 3.62 for next year. As I said, we could be there by the end of this year. Where do they see the landing zone, or where do they see rates next year? That's the trade. We know we got the marker. That's the market thinking 3%. Is the Fed going to confirm that? Be more dovish? Be less dovish than that? And once we got that, we'll get the final round of trading, and then we move back to watching the data and trading around the odd difference in rate moves rather than what's happening in the next 6 months. So yeah,
apart from that what is that Fed nowcast? Who are the ones who produce a number every 24 minutes?
The nowcast and the GDP
yeah,
now.
do we have any others? Do we have any others that come out a little, maybe a little less frequent, but
I don't know.
No, I don't know either, right? I don't know either, but I think it's going to be really axed on or concentrated on what's going on in the jobs and in growth, and that's why I would like to see exactly what's going on growth as well, to really say, okay, now this is going to push a much lower dollar. It could just be a grind, you know, a slow grind, and then I would still argue that euro, and then with what is waiting for the sterling perhaps as well, sterling being the slower ones, and we still see other currencies performing better than those two.
Yeah, I think I'm not sure if they put these on the calendar nowadays. These Atlanta Fed and
Yeah,
whatever
it's
one is.
there. We had one on Wednesday, I think.
Was it Wednesday? Was it?
Yeah, still 3.1, 3.2 or something. 3.1. Atlanta Fed
Yeah,
GDP now Q3 3.1 was on Wednesday.
Yeah, I mean, I only pay them lip service because they swing around like a whatever. There you go, 3.1. They can be a bit all over the shop. Yeah, Fred, the old St. Louis Fred portal is probably your best bet for all those GDP guessing games. Anyway, so moving on from that. So yeah, Fed data's all done and dusted. All we've got today is the Michigan. The flash Michigan numbers for September, which will give us another look at the consumer. They were on a better footing. I think we had two months of or 3 months of negative, then we had 2 bounces, and then we had it going backwards again last time. So what are we looking at today? Michigan. We're looking at unchanged. Brilliant. So anyway, because there's no other data coming, we're going to be susceptible to headlines. And this one might have a bit of a last impact for the week because there's nothing else to for the market to get its teeth into. So just keep an eye on that, and obviously keep an eye on those inflation expectation numbers, which were creeping up again. Right, moving on to the Fed and Besant. He's apparently going to aim to add 1 to 2 more names to the Fed shortlist of 2Ks and Walsh. He's also coming to the UK and Spain between 12th of September and 18th of September, in which Trump's scheduled to come over as well. So we might get some headlines for that next week. And a reminder, next week is a big central bank week. I think we've got the whole hog of the big ones next week coming through. So that's going to be a busy one, but we'll look at that on Monday. Speaking of messing around with the Fed, apparently only 16% of Yanks are backing the presidential power to determine interest rates and manufacturing operations, according to a Reuters Ipsos poll. So things are not happy over there with you guys over in US land. And once again, Turkey shows go big or go home. They cut their 1 week repo rate by 250 basis points versus the 200 basis points expected. And everyone else is arguing over whether the Fed does a 25 or 50.
Maybe Besson can put the Turkish central bank head on the short list for the Fed head.
Yeah, the only problem with that is there'll probably be 5 more before it gets to the interview stage, the way ergonomics works over there.
Yeah, well, yeah. Cut 250 BP straight away. Put it straight away at where Trump wants it, and then he can get sacked again. I mean, that's how it goes anyway in Turkey, right?
Yeah, exactly. Right, anything else you've got, Kay?
No thanks.
Good. I always like it when you say that. Right. Let me go to .en. Marion asking, am I still short? Yes, I am still short, although I did a bit of hedge trimming yesterday when we came down round to the 147.40s. I decided to get off a little bit of my trades on the average. I want to try and get things better. Then I got off a little bit more under. Just reminds me I need to update the trades room. I was trying to get a bit of 147s. I missed a couple of goes at 147 just to take a bit more off. But then I managed to get some off before bed, 147.15s. But yeah, I've chopped the position right down. I've got rid of some of my lower stuff as well. I might even have a little nibble up here again at in the near 148. So yeah, I've taken the position right down because I'm not overly clear on the price action at the moment. I was completely flummoxed by that move yesterday after the CPI. Even though it went my way, I didn't understand it, but that's the market for you. So yeah, I'm still happy to be short. I will be happy to play the range still, headlines permitting, because part of the trade is still looking forward to the Fed and what they're going to do. After that, though, who knows? We'll see whether I'm even still in the trade or not. One I want to point out, potentially significant, is $MEX. We've finally had a break of the 1850 level, which already is proving very significant. Now, this started happening late in my day last night, and everyone was talking about what's going on here in the room. And I say it's typical that we've come through weeks and weeks of Feds, data, NFPs, you name it, Trump, tariffs, the whole lot, and it's held. And then all of a sudden, randomly, it's going to start breaking at a stupid o'clock in the evening. But that's what it's doing. I did think it might have a bit more volatility to the break, but I suspect any big stops are sitting a bit further down than where we got. We probably triggered some under. We probably triggered some through 45s as well, but that hasn't lasted. But anyway, we are on a break, and it's confirmed right after rallies into the level are confirming. You don't get more technical perfection than this at the moment. Okay, this is still all short-term stuff, so this may still turn into be a bit of a fake out if we get back above when the Yanks come to town. If we close below 1850, then I think we're on for a bit more downside, or maybe quite some downside, because this is, when we were up in the 20s, both me and Kay talking about, if we get to 1850, long way away, we finally got there. Now this is potentially a big break. If you look at something like as I've been pointing out, you look at something like a monthly chart or a weekly chart, you think, these are the sort of big moves you get off of big levels like this, a couple of candles and wallop. We've had best part of nearly 3 months knocking along this line. Okay, you don't get levels like this every day in pairs. So if we do break here, it's got the potential to go massively to the downside. Potential. Okay, I will say that, and that's been the risk all the way through this. We've had this trend. It stopped here. It stopped here for a long time. Now we might be breaking. As I say, if we close below here this week, then it's going to look significantly. And who knows, you might get something like this. You could get some rallies, but if it's going to go, it could go. So this is going to be very important going forward. Now, I've scratched all my longs, or not scratched them, I scrapped them last night, and I took a little short. I'm still running shorts from up here, 21s, and I've still got some sell stops parked in at 1838 if this break goes through. But I might adjust those if this break under 1850 holds for a long time. What I want is stay below there. If we do, then we're probably going to go through that 1840 pretty quickly. So I may pull those sell stops and add to my short that I took last night at 48s. So I'm now just short this pair. Kay, what's your thoughts? Are we on for it, or is this just going to be a little fake out?
Yeah, well, my view, I haven't been trading it for a while, but I always thought it would be the end game, and looks like we're going. So I've started the short again as well. Also, through this whole thing of um, taking back and then the bounces, etc., etc. There was also always this red line of Scheinbaum, Ebrard, really trying very hard to stay on the right side of the Trump administration, right? And so I've always thought that sooner or later it would go, because even though that it can hurt them a little bit economically if they really slap those 50% on Chinese imports, because they are going to have to swallow the biggest part of those. They still will keep their market to the US open, right? So, and that is no matter how you turn it, still a positive for Mexico, right?
Yeah, absolutely.
And then you're still talking about an 8% or 7.5% currency, right? I mean, there is still a bit of carry in the trade, especially if the US now starts to cut again, even shyly, even 25s. And it's going to open the gap a little bit again with Mexico, unless they really go for another cut. I don't know when are they. I don't even know when the next meeting is.
I think
I
it must be next week
need
or end of September, I think.
I need to look it up. Yeah, I need to look it up. If when While you look at something else, I'm going to try to find when their next meeting is.
Yeah, go ahead, mate. Yeah, so a very interesting development in this one anyway. Right, let's look at what the Euro did again. And here we are, we're doing the same old thing. Another one still in the box. It's still looking positive for a move up to 118. But this 1850 is again a thorn in the side. Decent recovery again off this dip from yesterday, back up here. But as soon as we get here, we're running into trouble, and we just can't hold above there for any length of time. And that's what you need. And I can take this exactly to dollar mix as well. Imagine this is the 1850 level, but in reverse. Yeah, it looks like it's going, and then wallop, you're back in the box again. So until you get a length of time where this is confirming above 1750, or unless it goes straight through there and this high, forget about 118, 119, 120s. It's a pipe dream unless we can get above these smaller, closer levels. But it is still looking positive for a move higher. I'm an R in this week about maybe trying to pick a dip up around about that 117 level, but yeah, it's just been a bit messy. I'm more inclined to think about waiting for a break, let all the crap get cleared out, and then look to buy any dips that hold at any of the broken levels. I'm certainly not in the camp of wanting to go short in this one anytime soon. But again, measure this against the US. You're not buying. No one's buying the euro because everyone thinks Europe's going to be the next best thing in growth, even with the potential spending. This K is still all about the dollar mostly.
Yeah, yeah. And then as I said already a few times, I still think there are better dollars to be short of, if that is the way, of course, that people want to trade. Because we don't give advice here. We just tell what we look at. But yeah, if you want to be short dollars, I think there's better dollars to be short of.
Yeah. And last one before I hand it over to Mr. K, Aussie Kiwi. Let's get rid of that for a moment. Let's just get it out of the way. There we go. Aussie Kiwis having a break up. We've knocked through these prior highs. This dip did in fact turn out just to be a bit of a trend refresh as we've seen before. It held straight after. Now we're going on to this big level up here. This is one of the big range edges up here in the big 11-year range. We've been up here before. I've traded up here before, hence why I'm short in this one. I'm giving the range a go again. But I am mindful that this is a very, very strong trend that we're in at the moment, and I'm not seeing any reasons why it should change. So we've broken above this 50s level, these prior highs. This 1170, 80 area is a big old level. But if we're going through there, we're probably going well into the 112s. Maybe, let's go on a cleaner chart, maybe we're going to even go and test some of the wider tops. And I'm talking up here, 114s to 38.2 fib, okay, which is looking a bit of a monster level up there. So, yeah, things can tend to look bid at the top, but there's no denying this trend at the moment, Kay.
No, and it's you know what? I mean, it is obviously reflected in each of the dollar pairs, but it's really been going on for a while that the Aussie dollar is a bit of a cleaner trade than Kiwi versus dollar. And even on if you look at the pairs, it is a definite cleaner trade on the Aussie. Yeah, if you go into the shorter one, you know, that thing is bid, is really bid. And then if you just click on the Kiwi, it's much less obvious. You see, we can't get to those prior levels or get through it. You know, it's such a it is positive, and I mean it is positive. Both are positive, but Kiwi to me is a much less clean trade than the Aussie, and that's where your Aussie Kiwi comes into play, obviously. But it is really yeah, there is a market difference if you look at the dollar pairs, right?
Yeah, I'll bung it over to you, mate. So
Yeah, I've taken it. By the way, Banxico is on the 25th.
lovely. Cheers, mate.
Yeah, so I just want to start with this one, Kiwi, silver, because it's broken up, and I've said it for a while, that 41, 50, 60, top end of the the channel as well, but more importantly, this is breaking the very long-term 78.6 through 41.60, and as soon as it broke, hung around for what is it, an hour or so, and we just continue to fly, and this is still looking extremely positive. Okay, getting to the shorter end, as I already said earlier in the week, it was really holding pretty well, this fresh trend line support, and then as I said, I think it's going to break, but I don't know exactly when. So it did last night in New York. It not only broke through this 141.55.60, the prior high, but also the upper trend line of this channel has now been broken, and that came in at around 41.85 last night. So this is again seemingly wanting to go for the next leg. Levels above 42.85, 43.75, but you can see on the longer end, this is potentially going to take us into the 45s with perhaps an intermediate station as well in the long end, around 44.25. This prior high from where the big leg down started, but it is still extremely bullish, and as a result of it, I've now my very long term position. I've now really ramped up my stop loss. Where I was still around somewhere below 35 actually, but now I really ramped it up to just below this trend line, because even though it's extremely big, it is silver. It can be a bit of a rapid mover. If we get it close below 41.60, we could be more in a consolidation pattern, but for the time being, I just want to ride it for as long as it stays above this line. Gold, less bid. It's really silver doing the catch-up move there. That rather reflects the uncertainty that maybe that we still have on the inflation front or so, even though we have seen those yields in the US remain quite low. We have seen a little bit of a hold of US tens around 4%. Also a slight grab back of the twos. But overall, it's still extremely bullish as well for as long as we stay above 35, 85, 90-ish. I would say nothing changes even in the short term. This is just taking a breather, right? Because all the other conditions, the geopolitics especially, and as I pleased to say, that it's a hedge against everything that can go bad. All those conditions are still very much in place. So if ever we get back above these 36 three quarters, I think moving to the 37s and perhaps a bit higher. I've got a longer term potential target 39, but I mean it's still very much intact. But I would still say that a bit like my idea that I had the prior days, that it may just underperform silver just a little bit, okay? And then perhaps take a fresh direction up into the 37s and potentially higher for as long as we now hold 35, 85, 90 or so, okay? Euro Kiwi, Frederick, I think I did have a Euro Kiwi on. I think I did have a Euro Kiwi on at one stage, but no, not even. But it's correcting a little bit because of the euro, and I think it's the euro side doing it. The market is not fully on board, as Ryan already mentioned as well, with everything that can happen, the push in the economic situation, pan Europe. Okay, so now we are trading like around this 50% of that push higher. But we also have seen that the Kiwi is underperforming the Aussie. So the Euro Kiwi to me is not a clear-cut one. I don't know what you especially want to do with it, Frederick. If you could tell us maybe in the room what you want to do with it, really. But this seems like a kind of a logic move to me, because the uncertainty on either of those two currencies. I would say that if you look at something like Euro Aussie, for instance, that is much more clear-cut a bearish market we are in now. We have a clean break of this 176 three quarters. We're actually trying to get back up there. So keep a close eye on what's happening in Euro Kiwi. But I would say looking at the relative strength differences between Euro Kiwi on the one side and the Euro on the Aussie one side, I tend to think that the Aussie is still going to be the cleaner trade if we have to continue for moves up down into the 175s or so. On the Euro Kiwi, it's much less clear to me right from here, because we are just halfway. We could actually keep an eye on 197 three quarters if we get back up there. See what happens. If we fail there, we could actually trade a bit lower. But yeah, I think somewhere we're in the middle of the ballpark. I'm just going to look at one more because I'm looking at the clock. Cable. It can't get above 135, 90, 95 for now, which is really the gateway for it to trade up into the 136 and a half, 137s even, back to that zone potentially, but it can't. Yeah, we don't find it too much back on the euro sterling right now because that's in a 30-70 range, but I find it quite potentially significant if we can't close the week anywhere near it or even above it. It's not giving a great signal to me. So I would not exclude that we have perhaps a bit of a sluggish trade here, back into the high 134s perhaps. Not expecting huge moves there because we are stuck in this range, but could be significant that we can't get over this hump for now. Okay, so that is how I look at the cable right now. But current context of the dollar is still on the defensive, but again, this is like the euro dollar. Maybe there are better pairs to be long of, and then I'm thinking about stuff like the Aussie, for instance, which is, yes, it was capped. Yes, we are coming down, but it looks a bit better beat than euro or sterling right now, for instance. Okay, with that, Ryan, let's close this week, mate.
Yeah, thank you very much, mate. Brian's saying we need to make this show an hour. It's getting that way again, so we might need to do a bit of trimming because it's a lot to keep people engaged for that amount of time, and a lot of work for us as well. So yeah, we'll talk while we got something to say. Put it that way. Thank you, everybody, for coming to the Flow Show this week. This really has been an important week. For what's going to happen in the future. So I hope we've all steered you well. If we haven't, you can write a letter to Kay. He's head of complaints department for now. Thank you, Kay, as always.
Hey, not over the weekend, guys, okay?
Yeah. Complaints department closed over the weekend between 12 o'clock on a Friday to 12 o'clock on a Monday. So yeah, have a great weekend, everybody. We'll catch you later. We'll see you next week. Be good, be safe.